Hey, it's David Stenton with tonight's deep dive. It is February 6, 2018, and I thought I'd take a look at the 10-year notes here with the ETF being IEF. Now, we have the trends to the downside, short, intermediate, and long term. No surprise there, even with the little pop that we saw in the last day or so. There's still a downward trend across all of those different trend-based indicators. Now we do have a slight bullish technical rating for the market. The seasonals are still pointed to the downside over the next 21 days or so, but we're getting some signs here that a base is coming into the 10-year notes. Now it's an early phase here because I think there's going to be a lot of volatility that's going to pop up here, but we are getting these things that are starting to pop up. So in the elastic level, we got a slow low. The wave level, we got a wave low, and in the power level, we got a sub or a slow sub. All of these are basically telling us that the surge to the downside with the volatility we've seen over the last 2 days, it's putting in, according to these indicators, a bit of a base. Let's take a look at the patterns, and you'll see that a couple other things have popped up here just recently. We had a surge low, which was profit-taking for the sell-off that we've actually had, and then we had a dazed, which is an early warning signal that the market might be reversing. So there's a lot of things that are taking place here. But even with the indicators we have here with the pro alerts, as well as the elastic wave and power levels that we had on the previous page, there's still room for some possible volatility. So here is daily charts for the 10-year notes, and you can see obviously with the volatility you've seen in the stock market, we're seeing that same volatility here with the 10-year notes. Now, with the new Fed chairman, part of that could be the fact that the market is a little wary of that new person coming in and not knowing exactly how things are going to work out. But for the most part, I think that the market just simply sold off. The 10-year notes have reacted, and here is our volatility. Now, what we have here are a lot of these triggers here. Here's the elastic level, here's the wave low, and here is the power level sub. So they've all started to pop up here. But what I'm anticipating is sideways action with a lot of volatility, and then we'll see what actually happens, whether or not the market's able to head higher. Now, full disclosure, the systems are actually long the 10-year notes as it is right now, but you'll see here in a second that I think that that's premature, and I think that the volatility will get that system to liquidate itself, and we're probably looking at later in the month that we'd see any type of a bullish, true bullish bias, a safe bullish bias to the market. That's probably the best way to phrase it. So let's take a look here at a few things. One, just want to point out that we're currently in a obviously a drawdown period for the 10-year notes, and we're actually experiencing over the last 3 years its greatest drawdown. Currently, it's about 7.3%. So you can get an idea as to what's taking place here when it comes to the drawdown. I mentioned the technical review, and this is where we get it from. It's from the master watch list, and 10-year notes are right through here. So it's got a bullish bias, but it's not super strong. It's not like what we're seeing in some of the other markets. So just beware that it has a bullish technical rating to the market, but we'll see what's actually able to take place. Here's my concern. This is the seasonal tendencies. I don't give this a lot of bias, but because it is seasonally accurate right now, I'm going to give this a higher weighting than I normally would, just because it has a seasonal strength, not strength, but seasonal accuracy to the market. So here is the little triangle that represents where we are essentially right now, and we're going to be coming into a phase here in February where the market typically sells off. Now this is the 10-year chart. I know it's kind of small and difficult to see. It's just a byproduct of how we create these things. Here is a 5-year chart, and the peak typically occurs in the 5-year charts about now, and then it'll go into a bullish or bearish bias with some chop into early March. The 10-year, as I mentioned, that one is a little more dramatic and would end when it comes to the little box here. It would be late February, then it would have a surge, and then it would be another sell-off here, and then we'd have a nice little bullish bias for the remainder of the first half of the year. If we look at the 15-year, they're all basically pointing to this low that I'm talking about here in a couple of weeks. And from that standpoint, I'm a little cautious about the volatility what we're seeing in the market, and not saying that the bonds are going to go straight higher. In fact, what I'm saying is that the volatility associated with the market, we're going to see some chop, and that there's probably a better buying opportunity here in a little while. If we take a look at the projection. Some people know we have this and some people don't, but we always have projections, 21-day projections, and in this particular case the projection is to the downside. It's mixed, but it's still to the downside according to the 21-day, and what we're looking at here is the 19th of February is when we would see, according to all the different time frames, the 5-year, the 10-year, the 15-year, and the 20-year seasonal charts, they come up with this projection. So we'd be looking at mid to, well, I'll just call it February 19th-ish. It's not an exact science, but later in the month that we'd see some type of a base to the market, at least according to the seasonals. And I think that if I flip back here to the actual chart here, I'll just pull up a different one here, if I can find it. Okay, here it is. When you see these early warning signals, I still think that there's going to still be some of that chop, and there could be, even from the levels that we have right now, more of a bias to the downside until that February 19th period. Now, the other thing I want to point out on the weekly charts is that right now we are just below, well, we're basically touching this very strong, and these are weekly charts. So this is a 50 on a weekly chart. So I'm emphasizing this so you understand that this is major. So what we'd want to see is that the market itself, which is got the support at basically 121, that is the level that we would want to stay above, at least on a closing bar basis. Now, it surged below it yesterday, or I should say last week, and then this week with the volatility that we're seeing, we're essentially there. So just keep that in mind, that because of this support, and the meandering that I'm expecting, at least for the next couple of weeks or so, that there could be a buying opportunity. Now, I said that our systems are long the market. I don't know if it's how it's going to turn out, and all of the whether or not there's going to be an opportunity for that to really start to rocket to the upside. My gut tells me that we're going to see sideways consolidation more so than anything else. Then there's other factors, fundamental factors, and that are going to be out there that are going to start to really come into play here. So I'm not really willing to go out on a limb and give full disclosure or give full credit to that particular system as it is right now. But it is something that is taking place, and something that we do want to make sure that we have an opportunity here. Now, the one system, I'm just looking up on another computer, it's a 60-minute bar system. So the one that is actually along the market right now. So we'll see what actually does take place here. But just keep in mind, with that major support and the fact that we're getting a lot of basing with some of the elastic level, power level, and wave level indicators, and getting some early warning signals on the pro alerts. Even with all of that, I would still be very cautious here. I'm a very cautious trader myself, and so from that standpoint, I would just simply wait and see how things kind of stabilize a little bit for the next couple of weeks or so, and then look for greater opportunity. The other thing I want to point out here is I do an awful lot with all of these different charts. What I would suggest is, if you come to membership and core level overview, that there's a number of videos that I have here. One is kind of just a general overview, and then I have 3 other videos that go into greater detail on perspective, context, and trade action. and these are the topics for the other videos. The other videos can be found up here. So this is core level 1, and then we've got core level overview, and then we have level 1, 2, and 3. So something that you might want to consider watching those just to get a better feel for some of the other charts that we actually have on the website, and some of the things that we talk about on a regular basis, where I'll go into at least a little more detail. So that's tonight's deep dive, and hopefully we'll be able to look at some more markets tomorrow. Thanks very much.